Okay, so you want to own a power plant. Towering cooling towers releasing steam into the sky, turbines spinning around the clock, a facility that quite literally keeps the lights on for hundreds of thousands of homes, and a business model that sounds almost boringly simple. Burn fuel or split atoms or capture wind, spin a turbine, sell electricity. You picture yourself as the steady, essential utility owner, collecting predictable revenue from a product nobody can live without. That's the fantasy. Here's the actual business hiding underneath it. An industry where a single plant can cost anywhere from tens of millions to tens of billions of dollars to build depending on which technology you choose. Where the wholesale price of the exact same product you're selling can swing by a factor of 10 or more within a single day. And where the regulatory environment you operate under can be so fundamentally different from state to state that the same power plant built in two different locations represents to almost entirely different businesses. Some power plant owners have built extraordinarily durable, multi-decade cash-generating assets. Others have built technically excellent facilities that became stranded, uneconomic assets within a few years of opening, victims of a market or regulatory shift they never saw coming. By the end of this, you'll understand exactly why owning a power plant is one of the most capital-intensive, technologically diverse, and regulation-dependent businesses in the entire economy, and why the answer to does this make money depends almost entirely on which specific type of power plant, in which specific market, you're actually asking about, what you're actually buying before the money makes sense. You need to understand that power plant describes a genuinely enormous range of different businesses, and the specific generation technology you choose determines almost everything else about the economics that follow. Natural gas plants, the most common new generation built in the United States over the past 2 decades, come in two meaningfully different flavors. Simple cycle plants, which can start up quickly to meet sudden demand spikes but run less efficiently, and combined cycle plants, which capture waste heat from the gas turbine to generate additional electricity through a steam turbine, achieving considerably higher fuel efficiency but requiring a larger upfront investment and longer, less flexible startup times. Coal plants, once the backbone of American electricity generation, have become an increasingly difficult economic proposition, facing both tightening environmental regulation and direct cost competition from cheaper natural gas and renewables, a combination that has driven a wave of coal plant retirements over the past decade, even in plants that remain physically capable of operating for decades more. Nuclear plants represent the single largest upfront capital commitment in the entire industry, requiring tens of billions of dollars and a decade or more of construction and licensing before generating a single watt of revenue. But once operational, they run at extraordinarily high utilization rates for 6 to 8 decades, with fuel costs representing a remarkably small share of total operating expense. Renewable generation, wind and solar specifically, has undergone the most dramatic cost transformation of any generation technology over the past 15 years, with construction costs falling so substantially that new wind and solar projects now frequently represent the cheapest source of new electricity generation in many markets, though both technologies share the same fundamental limitation of only generating power when the wind blows or the sun shines, a variability that creates genuinely different revenue and grid integration economics than a plant that can generate on demand. Understanding which of these technologies and which specific regulatory market a given plant operates within explains an enormous share of whether it's a durable, profitable asset or a genuinely risky one, because unlike almost any other business in this series, power generation economics are shaped as much by the regulatory structure surrounding the plant as by the plant's own physical characteristics. The two regulatory worlds share the single most important structural fact shaping power plant economics in the United States, and it explains why the exact same physical power plant can represent to almost entirely different businesses depending on where it's located. Roughly 2/3 of the country operates under a regulated utility model, where a vertically integrated utility owns generation, transmission, and distribution together, and a state public utility commission approves the rates that utility can charge customers, guaranteeing the utility a regulated rate of return on its approved capital investments in exchange for accepting price controls and a legal obligation to serve all customers in its territory. Under this model, building a new power plant is fundamentally a regulatory negotiation as much as an engineering project, since the utility has to convince state regulators that the new plant is a prudent investment that should be included in the utility's rate base, the pool of assets on which it's allowed to earn its regulated return, and once approved, the plant generates a predictable, contractually guaranteed return for decades, regardless of how wholesale electricity prices in the broader market happen to fluctuate. The remaining third of the country, including major markets like Texas, California, and most of the Northeast, operates under deregulated wholesale markets, where power plants compete directly against each other in real-time and day-ahead auctions run by independent grid operators, selling electricity at whatever the market clearing price happens to be in a given hour, with no guaranteed rate of return and genuine exposure to the full volatility of wholesale power prices. This distinction matters enormously for anyone evaluating power plant economics, because a regulated utility plant and a deregulated merchant plant are fundamentally different investment propositions. The regulated plant offers a lower, but highly predictable, contractually protected return, closer in risk profile to a utility bond, while the merchant plant offers potentially higher returns during periods of tight supply and high prices, but genuine exposure to the kind of brutal price volatility and periods of unprofitability that can threaten the plant's ability to service its construction debt, a risk-return trade-off that has shaped where different types of investors and different types of generation technology have concentrated their capital over the past 2 decades. The cost of actually building the thing. Capital cost of building a new power plant varies so dramatically by technology that comparing them side by side reveals just how different these businesses actually are. According to construction cost data tracked by the U.S. Energy Information Administration, a new combined cycle natural gas plant costs somewhere in the range of $700 to $1,200 per kilowatt of capacity, meaning a genuinely large 1,000 megawatt facility runs roughly $700 million to $1.2 billion to build, with construction typically taking 2 to 3 years from groundbreaking to commercial operation. Utility-scale solar has fallen to remarkably low construction costs, commonly $800 to $1,500 per kilowatt depending on location and whether battery storage is included. Though solar's lower capacity factor, meaning it only generates during daylight hours and at reduced output during cloudy conditions, means comparing raw construction cost per kilowatt somewhat understates the effective cost per unit of actual electricity delivered compared to a plant that can run continuously. Onshore wind construction costs run similarly in the range of $1,200 to $1,700 per kilowatt, with offshore wind, an increasingly significant category particularly along the U.S. East Coast, costing considerably more, commonly $3,000 to $5,000 per kilowatt or higher. Given the substantially more complex marine construction, specialized vessels, and underwater transmission infrastructure offshore projects require, nuclear power represents the extreme end of construction cost and complexity. With new nuclear projects in the United States, most notably the Vogtle expansion in Georgia, the only new nuclear construction completed in the United States in decades, ultimately costing over $30 billion for 2 new reactors, a figure that came in dramatically over its original budget and years behind its original schedule, illustrating the genuine construction risk that has made new nuclear development in America extraordinarily rare over the past several decades despite the technology's excellent long-term operating economics once actually built. Beyond the generation equipment itself, every power plant requires substantial transmission interconnection investment, the infrastructure connecting the plant to the broader electrical grid, and in many of the country's fastest-growing regions, The queue of projects waiting for grid interconnection studies and approval has grown so long that some projects wait years simply for a confirmed connection date before construction can even begin, a bottleneck that has become an increasingly significant industry-wide constraint, particularly for renewable projects being developed in remote, resource-rich locations far from existing transmission infrastructure. The bill that never stops arriving. Operating costs vary as dramatically by technology as construction costs do, and understanding this variation explains a great deal about which plants remain profitable across a full market cycle and which don't. Fuel cost represents the dominant ongoing expense for natural gas and coal plants, and natural gas price volatility in particular has become one of the most consequential variables in the entire industry's profitability. Since natural gas prices can swing considerably based on broader energy market conditions, weather-driven demand spikes, and increasingly, the growing linkage between domestic gas prices and global liquefied natural gas export demand, meaning a gas plant's profitability can shift substantially based on fuel market conditions entirely outside its own operational control. Nuclear plants, by contrast, have remarkably low fuel costs relative to their total operating expense, since uranium fuel represents a small fraction of total operating cost, with the majority instead going toward the specialized labor, maintenance, and regulatory compliance required to operate a nuclear facility safely, a cost structure that gives nuclear plants genuine insulation from fuel price volatility, but also means their profitability depends heavily on running at consistently high utilization, since so much of their cost is fixed regardless of how much electricity they actually generate. Renewable generation carries essentially zero fuel cost, since wind and sunlight are free, meaning a wind or solar plant's economics are overwhelmingly determined by its upfront construction cost and ongoing maintenance rather than any variable fuel expense, a fundamentally different cost structure that has made renewables increasingly competitive as construction costs have fallen. Though this same zero marginal cost characteristic means renewable plants can sometimes bid into wholesale markets at prices that would be unprofitable for a fuel-burning plant to match, creating genuine competitive pressure on conventional generation during periods of strong renewable output. Every plant, regardless of technology, requires ongoing maintenance, and for large thermal plants, periodic major overhauls that take the facility offline for weeks at a time represent a substantial, unavoidable cost cycle similar to the turnaround maintenance we've discussed in other capital-intensive industries. Environmental compliance costs have become an increasingly significant and evolving expense category, particularly for coal and, to a lesser extent, natural gas plants, as emissions regulations have tightened over the past 2 decades, and a plant facing a major required environmental retrofit. New pollution control equipment mandated by updated regulations sometimes faces an economic decision between the substantial cost of the retrofit and simply retiring the plant early, a calculation that has driven a meaningful share of the coal plant retirements the industry has experienced over the past decade. How the money actually comes back. Revenue models in this industry vary considerably depending on the regulatory structure and specific contractual arrangements a plant operates under, and understanding these different revenue streams explains why two plants generating the exact same amount of electricity can have dramatically different financial profiles. A regulated utility plant earns its return through rates approved by state regulators, providing predictable, cost-plus return revenue that doesn't depend on real-time wholesale market conditions, a structure that trades lower potential upside for genuine downside protection. A merchant plant operating in a deregulated market earns revenue through some combination of energy sales at the wholesale spot price, which fluctuates by hour based on real-time supply and demand, and capacity payments, a separate revenue stream that some deregulated markets provide specifically to compensate plants for simply being available to generate when called upon, recognizing that a grid needs reliable backup capacity during hours when that capacity is actually running. Many merchant plants, particularly newer renewable projects, increasingly secure long-term power purchase agreements directly with corporate buyers, a structure that has become especially significant given the enormous electricity demand growth from data centers and AI infrastructure discussed in our data center analysis, with several major technology companies signing multi-year, sometimes decade-plus contracts to purchase power directly from specific generation projects, providing the kind of revenue certainty that makes financing a new plant considerably easier than relying entirely on volatile wholesale spot market pricing. According to wholesale market data tracked by grid operators like PJM, ERCOT, and CAISO, wholesale electricity prices in deregulated markets can range from single-digit dollars per megawatt-hour during periods of oversupply, sometimes even turning briefly negative during periods of excess renewable generation when the grid literally pays plants to reduce output, to prices exceeding $1,000 or even several $1,000s per megawatt-hour during periods of extreme demand or supply scarcity, a volatility range that dwarfs almost any other commodity market, and that means a merchant plant's annual profitability can depend disproportionately on capturing revenue during a relatively small number of genuinely extreme price events each year, a dynamic the industry sometimes describes as a small number of hours generating an outsized share of a plant's annual profit. The volatility nobody wants to talk about beyond the fuel price and wholesale price volatility already discussed. This industry carries several other distinctive structural risks. Regulatory and policy risk represents a genuinely significant, ongoing vulnerability, since power plant economics can be reshaped substantially by policy shifts, changes to environmental regulations, renewable energy mandates, carbon pricing policies, or capacity market rule changes that can meaningfully affect a plant's competitive position relative to other generation types, sometimes with relatively little advance notice relative to the multi-decade time horizon over which a plant's construction costs need to be recovered. Technology and market transition risk has become an increasingly serious concern for conventional thermal generation specifically, since the combination of falling renewable costs, evolving grid reliability requirements, and shifting policy priorities has created genuine uncertainty about the long-term competitive position of coal and, over a longer horizon, potentially even natural gas generation, meaning an owner financing a new thermal plant today is making an implicit bet about how quickly that transition will unfold, relative to the plant's ability to fully recover its construction costs before facing genuine, competitive, or regulatory pressure to retire early. Interconnection and grid capacity constraints, discussed earlier as a construction bottleneck, also represent an ongoing operational risk, since a plant's ability to actually deliver its generated power to customers depends on transmission infrastructure that the plant owner frequently doesn't control, and transmission constraints can effectively strand otherwise economic generation in locations where the grid simply can't move enough power to where demand actually exists, a genuine and growing problem in several of the country's fastest-growing renewable generation regions, and weather-driven operational risk has become an increasingly prominent concern following several high-profile grid failure events, most notably the February 2021 Texas winter storm, which exposed genuine vulnerabilities in how thermal generation equipment across an entire region can simultaneously fail during extreme cold if that equipment hasn't been specifically weatherized for conditions outside the region's historical norms, a risk that illustrates how a plant's technical reliability assumptions, built around historical weather patterns, can be caught genuinely off guard by increasingly extreme weather events. The real case study, the Texas winter storm grid failure, to understand how catastrophically operational risk can materialize in this industry. Look at what happened across the Texas power grid during Winter Storm Uri in February 2021. Texas operates its own largely independent, deregulated electricity market run by ERCOT, a structure that has generally been credited with fostering genuine wholesale price competition and rapid renewable energy development. But that also means Texas's grid operates with less interconnection to neighboring regional grids than most other parts of the country, limiting the state's ability to import emergency power from outside the region during a crisis. When an unusually severe winter storm brought extreme cold across the entire state simultaneously, a combination of natural gas production freezing at the wellhead, power plants themselves experiencing equipment failures from cold weather they weren't adequately winterized to handle, and a surge in electricity demand for heating all struck at the same time, and because so much of the state's generation fleet failed simultaneously rather than the more typical pattern of individual plant outages spread across time, ERCOT was forced to implement rolling blackouts across the state to prevent a complete, catastrophic grid collapse. According to subsequent regulatory investigations and reporting, the blackouts left millions of Texans without power for days during genuinely dangerous cold conditions, resulted in a substantial number of deaths attributed to the storm and subsequent power outages, and triggered wholesale electricity prices that spiked to the market's price cap of $9,000 per megawatt hour for days at a time, an extraordinary price level that generated enormous windfall profits for generators that managed to keep operating throughout the crisis while simultaneously bankrupting several retail electricity providers and cooperatives who had sold customers fixed-price contracts while being forced to purchase replacement power at those extreme spot prices, a mismatch that illustrated a completely different risk category than plant-level operational failure. The crisis prompted a significant regulatory response, including new mandatory weatherization requirements for Texas generation and gas infrastructure, along with extensive litigation and political controversy over both the causes of the failure and the appropriateness of the extreme prices some generators earn. During the crisis, the Texas grid failure illustrates a genuinely crucial structural lesson for this entire industry. A power plant's operational reliability assumptions are built around historical weather patterns for its specific region, and when weather conditions exceed those historical assumptions, the resulting failure isn't contained to a single plant. It can cascade across an entire regional grid simultaneously, precisely because many plants across the region share the same underlying vulnerability to conditions their equipment was never specifically designed to withstand, a systemic risk that individual plant-level engineering excellence cannot fully protect against. When the entire surrounding system experiences simultaneous stress. To scenarios, let's build the honest math the way an actual owner has to run it. In the good scenario, you own a combined cycle natural gas plant or a large-scale renewable facility operating under either a stable regulated rate structure or a long-term power purchase agreement with a credit-worthy corporate buyer, providing predictable, contractually secured revenue over a multi-decade horizon. Your plant runs at a strong capacity factor with well-managed fuel costs or, for renewables, minimal ongoing operating expense, and your revenue comfortably covers your construction debt service, operating costs, and generates a healthy return on equity, often in the range of 8 to 12% for a well-contracted asset, a genuinely attractive, long-duration return profile that has made power generation assets increasingly popular among infrastructure investors specifically seeking this kind of stable, inflation-protected, multi-decade cash flow across the life of your power purchase agreement or regulatory rate case. Your plant generates durable, predictable returns with relatively modest ongoing risk, precisely the kind of asset that has attracted enormous institutional capital into the power generation sector over the past decade as investors have sought genuine alternatives to more volatile equity market returns. Now the harder scenario. You own a merchant natural gas or coal plant operating in a deregulated wholesale market without a long-term contracted revenue stream, financed with construction debt that assume reasonably strong average wholesale prices over the life of the loan. Natural gas prices spike unpredictably, compressing your margin between fuel cost and wholesale electricity price, while simultaneously falling renewable construction costs and continued wind and solar development in your market push down average wholesale prices during the hours your plant would otherwise be running most profitably. Since renewables generating at zero marginal cost during favorable weather conditions can push wholesale prices down precisely during the hours you'd normally expect strongest demand and pricing, your plant increasingly finds itself running at reduced utilization, generating electricity only during the narrower window of hours when renewable output is low and demand is high enough to justify your higher marginal cost, and your revenue, entirely dependent on capturing sufficient value during that narrowing window of profitable operating hours, falls short of what your original financing assumed, creating genuine debt service stress and, in a severe enough scenario, the kind of stranded asset dynamic that has already forced the early retirement of numerous coal plants and increasingly threatens certain merchant gas plants in markets experiencing rapid renewable build-out. The gap between these two scenarios in a modest variance in a financial model. It's the difference between one of the most attractive, stable infrastructure assets available to institutional capital today and a genuinely difficult, potentially stranded asset entirely dependent on a regulatory and market structure that, unlike the plant's own physical equipment, can shift substantially over the multi-decade horizon required to fully recover the plant's enormous upfront construction cost. The real payoff, the difference between power plant owners who build lasting, multi-decade wealth in this business and those who end up holding a stranded, uneconomic asset comes down to a small number of disciplined choices specific to this industry's unusual structure, securing long-term contracted revenue, whether through a regulated rate case or a genuine power purchase agreement with a creditworthy buyer, rather than betting entirely on merchant wholesale market pricing, has proven again and again to be the single clearest differentiator between plants that generate the kind of predictable, bond-like returns that make power generation attractive to patient, long-duration capital, and plants that carry genuine, difficult-to-predict exposure to a wholesale market whose pricing dynamics can shift substantially over a plant's multi-decade operating life. Understanding, before committing tens of millions or billions of dollars to construction, exactly which regulatory environment and market structure a plant will operate within, and specifically how that environment might evolve over the plant's operating lifetime as renewable costs continue falling and policy priorities continue shifting, matters more in this industry than in almost any other business in this entire series. Precisely because the regulatory and market structure surrounding a power plant frequently matters more to its ultimate profitability than the plant's own physical engineering excellence, and building genuine resilience against the kind of extreme weather and operational stress the Texas grid failure demonstrated, rather than assuming historical weather patterns will continue indefinitely, has become an increasingly important lesson across the entire industry as weather patterns have grown less reliably predictable than the multi-decade historical baselines the industry's engineering and financial models were originally built around. The romance of the essential, steady utility business, keeping the lights on for hundreds of thousands of people, is genuinely real, and the plant owners who have built the most durable wealth in this industry are the ones who understood that the physical technology, gas turbine or nuclear reactor or wind farm, was never actually the determining factor in their plant's long-term success. The regulatory structure and contractual revenue certainty surrounding that technology was, which means the honest answer to whether owning a power plant can build genuine, lasting wealth is yes, unambiguously, for owners who secure the kind of stable, long-term contracted or regulated revenue that this industry's most successful assets have consistently relied upon. But the industry's history, from stranded coal plants to Texas's catastrophic grid failure, has made unmistakably clear that a power plant's fate depends as much on the regulatory and market structure surrounding it, and the weather patterns testing it, as on how well the plant itself was actually built. And subscribe to Alma Discover for more videos. Thank you.